and the International Monetary Fund has given its lowest global growth outlook in over a decade, amid uncertainties over the US-China trade war and the prospect of a no-deal Brexit. In its latest report, out just a short while ago, the IMF says that it now expects the global economy to grow by 3% this year, and that is down from the 3.2% forecast in July. Let's go straight to Jagruti Dave in Washington. Jagruti, it sounds like the report makes for sobering reading. Lay out the key details for us.
Yes, indeed it does. The key details, as you said, global growth in 2019, 3%. This is the slowest the economy has been since the 2009 recession. The word precarious was used to describe the global economy. So this is strong words from the IMF. Just a little bit more detail on what this 3% means. It's down by 3 percentage points from a forecast in July, as you say, about 6 months ago. Also, it's down from a forecast in 2017. Which suggested there would be a 3.8% growth. So this 3% is a stark difference to previous forecasts. The causes that the IMF laid out were the rise in global tensions, in trade tensions, and rising trade barriers. And this is, we've seen all around the world, this is a feature of global politics. And so these are some of the reasons. She outlined some of the sectors that were affected, manufacturing, the automobile sector, for example. And she also laid out recommendations, very loose recommendations, but very firm recommendations to central banks, policymakers and world leaders on how to avert further slowdown in the future.
It seems that policymakers really don't have much choice other than to sort of transcend the turbulence and navigate these rough waters. They don't have much room for mistakes. So what are the best options open to them, Jagruti?
Well, one of the things that the IMF recommended was that the central banks continue their loose policies. So they commended the Federal Reserve and the European Central Bank's interest rate cuts, for example. Some of the other recommendations that the IMF made were to world leaders, almost a pointed comment to President Trump here in the United States, saying you need to reverse trade barriers, you need to reverse the tariffs, and you need to rein in geopolitical uncertainty. This is something that is a forefront in a lot of people's mind as we look at this latest agreement that President Xi of China and Donald Trump are likely to make, this phase 1 deal, which could be sedimented in the APEC summit in Chile next month. So there's not much room for mistakes here. The IMF also talked about Brexit as a potential pitfall, a no-deal Brexit, which is currently being thrashed out at the moment. So it's all on a tightrope right now.
We still may be some way away from the US and China sort of inking that deal and to what extent it will be. But how will this report impact sentiment, perhaps with investors?
Yes, so something that the IMF said and something that we all know is that confidence, the confidence effect, as the IMF said, is a great indicator of how the markets react and how sectors will react. So global manufacturing has been slowing down, which will cause concern for producers and for jobs, for example. The policymakers in banks, they will be concerned as to whether they are making the right decisions when it comes to cutting interest rates or raising interest rates. The automobile sector, as I mentioned earlier, is also slowing down, and a lot of these products are at the centre of tariff disputes, tit-for-tat trade tariffs. So these are all sectors that are going to be on the edge of their seats because their jobs, their livelihoods are going to be impacted based on the global growth forecast, but also based on what governments, what policymakers decide to do, whether tariffs are playing in their sector and whether that is indeed going to impact growth in the future, which the IMF says it is most likely to do so.
Jagruti, thank you very much for helping us analyse this IMF report that's just out.